Should we have known the dangers? Fraud aside, we should have known better. We should have known that investments in transforming technologies have often proved unrewarding for investors. In the 1850s, the railroad was widely expected to greatly increase the efficiency of communications and commerce. It certainly did so, but it did not justify the prices of rail stocks, which increased to enormous speculative height before collapsing in August 1857. A century later, airlines and television manufacturers transformed our country, but most of all the investors lost their surge. The key to investing is not how much an industry will affect society or even how much it will grow, but rather its ability to make and sustain profits. And history tells us that eventually or excessively observant, the market succumbed to the laws of gravity. The consistent losers in the market, from my personal experience, were those who are unable to resist being swept up in same kind of tulip birds cries. It is not hard really to make the money in the market. As we shall see later, an investor who simply buys and holds a broad-based portfolio of stocks can make reasonably generous long-run returns. What is hard to avoid is the alluring temptations to throw your money away on get rich quickly begins. Banjis. There were many villains in this mortal tale. The fee offset the underwriter, who should have known better than to peddle all the crap they brought to market. The research analysts who were the cheerleaders for the banking departments and who were eager to recommend net stocks that could be the pushes by the commission-hungry brokers. Corporate executives using creative accounting to inflate their profit, but it was the inflationary greed of individual investors and their susceptibility to get rich quickly. Schemes that allowed Barber to expand. And yet the melody lingers on. I have a friend who built a modest investment stack into a small fortune with a diversified portfolio of bonds, real estate funds, and stock funds that own a broad selection of blue-chip companies. But he was listless. At cocktail parties he kept running into people buzzed in about this net stock that tripled or that the telecom chip maker that doubled. He wanted some of the action. Along came a stock called Boo.com, an internet retailer that planned to sell with no discounts urban chic clothing that was so cool it wasn't even cool yet. In other words, Boo.com was going to sell at full price clothes that people were not yet wearing. But my friend had seen the cover of Time with the headline, "Kiss your mail goodbye. Online shopping is faster, cheaper, and better." The prestigious firm of the JP Morgan had invested millions in the company, and Fortune called it one of the cool companies of 1999. My friend was hooked. This Boo.com story will have all the tip type witches dueling with excitement and conjuring up visions of the castles in the air. Any delay in the buying would be self-defeating, and so my friend had to rush into before greater fools would trade. The company below the throwed $135 million in 2 years before going bankrupt. The co-founder, answering the charges that the her firm spent to extra-brutality, explained that I only flew to Concord 3 times and they were all special officers. Of course, my friend had bought in just at the height of the bubble, and he lost his entire investment when the firm declared bankruptcy. Ability to avoid such a horrible mistake is probably the most important factor in preserving one's capital and allowing it to grow. The lesson is so obvious and yet so easy to ignore. Okay, we read this paragraph. So should we have known the dangers? Today, as for we saw some several effects in terms of the Kospi, this Korean stock market figures. A couple of days ago, they hit 3,000 over the 3,200 figure a couple of days ago, but now a little bit down and around the 3,000 figures Kospi in Korea today. And there are also several influence from like especially the Samsung, some electronic, the issues and so on. And so it is really hard to estimate some dangers and how can we expect go up and down, but we can realize and we can recognize it to feel like well go down, and so we should take care about some figure and trends and atmosphere circumstance when we have some succumbing to risk. Okay, let's see the finer paragraphs. A final word, probably more so than any other chapters in the book. This review of the internet bubble seems inconsistent with the view that the stock market is rational and efficient. The lesson from this chapter, it seems to me, is not that markets occasionally can be irrational and therefore that we should abandon the firm foundation theory. Rather, the clear conclusion is that in every case, the market did correct itself. The market eventually corrects any irrationality, arbits in its own slow, inexorable the fashion. Anomalies can crop up, market can get irrationally exuberant, and they often attract onward investors. But eventually true value is recognized by the market, and this is the main reason investors must heed. I'm also persuaded by the wisdom of Benjamin Graham, author of security analysis, who write that is the final analysis. The stock market is not a voting mechanism, but a whittling mechanism. Valuation metrics have not changed. Eventually, every stock can only be worth the value of the cash flow it is able to earn for the benefit of investors. In the end, true value will win out. The important investment question is how you can estimate true value. More about this is chapter 5, where we will take a closer look at how professionals attempt to determine what a stock is truly worth.